Min is on travel.
Okay. I'd like to call a meeting to order. Can I have a roll call, please?
Commissioner Nguyen, absent. Commissioner Solomon?
Here.
Commissioner Johnson?
Here.
Commissioner Morocco, absent. Commissioner Esser?
Here.
Commissioner Samples?
Here.
Chair Chen?
Here. Could I have Commissioner Esser salute to the flag, please?
Yes. Ready, begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Item number 2, approval of order of agenda.
Make a motion to approve the agenda. Second.
Do I have a second? All in favor?
Aye.
Aye. All opposed? None. Motion passes. Item number 3, additional items for immediate consideration, blue folder items. There are no blue folder items. Item number 4, consent calendar. Subpoint number 4, approval of affidavit of posting for the regular Budget and Finance Commission meeting of July 12, 2018.
So moved.
Yeah, second.
Second.
Can I, all in favor?
Aye.
Aye. All opposed? None. Motion passes. Approval of minutes, of following minutes of May 24th, 2018.
No comments, so I move to approve.
Yeah, I motion to approve.
Second.
All in favor?
Aye.
Aye. Motion passes. Item number 5, excluded consent calendar. No items. Item number 6, public participation on non-agenda items. People must be on vacation.
We're back to normal on the public. We were on a streak for a while there.
It's not you, it's us.
Item number 7, old business. No old business. Item number 8, new business. Number 6, CALPers update and path forward presentation. Marnie?
Yeah, with us we have David Takeart from the stakeholder strategy. He's a stakeholder strategy manager for CALPers, a role in which he oversees communications and outreach to stakeholders on pensions, retirement security, investments, and healthcare policy. In his 5 years with PERS, David has worked closely with elected officials and professional management representing local governments, labor associations, school districts, retiree coalitions, and taxpayer advocacy groups to communicate policy developments before, during, and after implementation. He oversees CALPers' framework of briefings, roundtables, conferences, webinars, and educational workshops across the state. He brings over 15 years of combined financial and public presentation experience to the role, having worked for the Golden One Credit Union in Sacramento as a trainer and project manager before joining CALPers in 2012. He has 2 8-month-old twins, Alice and Audrey, so he's very happy to be here right now. And so he'll give a presentation and take any questions you have.
Good evening. This is not bending very well. Can you hear me, though? There we go. Okay. I can just use this. Great. Thank you for the introduction, Marnie, and thank you all for the invitation here this evening. So my name is David Takeart. As you heard, I'm the Stakeholder Strategy Manager for CALPers. So I manage and oversee the outreach and communications function for the enterprise. And so I'm delighted to be here this evening and share an update on the overall system performance, past, present, and what we see for the future, what the path forward is. And I'm also pleased to share some specific detail on City of Redondo Beach's own contributions and projected contributions going forward. This is very good timing because the next year's value, the next set of contributions are being calculated right now and finalized, but I have a little preview for you. It's not set in stone yet, but it'll be very, very close. So this will be very helpful in looking at projected budget forecasting and identifying opportunities for the city to look at what the costs are and see what you, in collaboration with your employees and stakeholders, want to do in terms of handling those costs. So I'll run through this. I feel like we can be very informal here. Obviously, there's not a huge public presence, so happy to take questions throughout. I think you'll find that there's some natural kind of like ebb and flow to this, and I'll pause frequently for questions. But if something comes up, please don't hesitate, and we can just dialogue on that.
I actually did have a question to start with.
I'm sorry, that's too soon.
Sort of to set the stage, just so that we ask you the appropriate questions. I mean, you're here to explain the mechanics and things like this. It's probably not, a forum for us to complain about, union controls and things like that, or who's in PERS and why. You're here to explain the math to us, correct?
That's correct.
Right.
Thank you. Okay, so let's go ahead and dive into this. So up first, just a little bit of big picture view of what CALPers is and who we do represent and serve. So CALPers is the biggest pension system in America. It's a bigger pension system than that which serves the federal employees, 1.9 million members and their families. It's roughly broken out in thirds between the three major public sectors that we serve. That would be public agency members, which includes cities like this, counties, special districts. Those are public agencies. Then there's the state employees like me. So CalPERS is the state agency, DMV, Caltrans, et cetera. And then surprisingly to a lot of folks, the schools actually makes up the largest percentage of membership. So folks who aren't certificated teachers, but who work at school districts are part of CalPERS. So that would be, very often your school administrators, bus drivers, janitorial, et cetera. So there's a wide and diverse membership. There are different pension formulas. There are different unions representing these folks. So it's a very complex system. And this makes it challenging, I think, for a lot of stakeholders who follow in the news to really track with exactly what's happening, because very often you'll see people conflating the state in terms of the employer, the state of California employer, versus California, the state. So the numbers often get flip-flopped around to serve whatever narrative purpose the author wants to see. So one of the things I want to do here is clarify and just make sure that we're speaking with the right nomenclature. As I go through this, I'll be careful to point out when we're talking about the system as a whole. So the system being all 1.9 million members and the 3,000 different employers. So Redondo Beach is one. There are 2,990 some odd other employers. All those school districts, the state is one as well. And there's just so many cities, public agencies, small districts, counties, and county agencies. So it's a big scope. Here's a look, diving right into the meat of the matter here. Here's the financial performance of the fund, looking at different blocks of time. So on the left, you see our most recent official fiscal year return, which was 11.2. Literally today, and when I say today, I mean this date and time, we announced our preliminary results for the last fiscal year, the year ending July or June 30th, and that was 8.6. Okay, so all the numbers that you're seeing here will need to be updated, but I didn't have time to do them all today. But if you look at the most recent 5-year block of time, the return average for the fund is 8.83. Going back 10 years, you catch the tail end of the Great Recession, and that's why you see a big dip down there to 4.39. Going back further, you get the full brunt of not just the Great Recession, but the dot-com bust as well. And then back to 1988, so about 30 years, it's an 8.4%.
Commissioner Johnson?
I'm sorry, David, are these numbers net to expenses, or are these gross figure?
These are net. This is the overall performance of the fund. We always factor in our operational expenses, but even though they're high in raw numbers, like the total operational expense for the organization is high. It's less than 1% of the total expense.
The management fee?
Yes.
Okay. All right, thank you.
All of the staff, all of our external manager, like everything is still less than 1%.
Roll that all into one number.
That's correct.
It's not separated out.
No, so we want to make it as honest as possible.
Okay.
So you do have internal and external managers.
We do have internal and external, yes. And when we get, I'll show you the asset allocation, and there are certain sectors that are handled more internally and some of them that are almost entirely external, and that is actually a kind of like a crux of decision-making right now for the path forward. I think one thing to look here before we move on from this slide is that I think there's a lot of debate and concern as to whether or not CalPERS has the even raw ability to earn the investment returns that we forecast and upon which employer contributions are made. I think there's a lot of folks who, on both sides, folks who think that we can't meet our expected returns, and there's almost an equal number of folks who say, you can do better, why are you being so risk averse? Our discount rate is the term that we use for that targeted rate of return, that sort of benchmark for if we hit it or exceed it, we've done well and things are looking pretty good. And if we underperform, then there's going to be challenges, especially to the employers. So right now we're at 7.5. If you've been following, we've lowered the discount rate. We've scheduled the discount rate to lower in a 3-year phase down to 7%. So last year, this most recent one here, 11.2, the goal was 7.5 when he hit 11.2. This next year, it's 7.375 because we're kind of in the first stage of that drop down, and we just hit that 8.6. So while we don't want to get too, accustomed to patting ourselves on the back, I think it shows that CalPERS does have the raw ability to hit it. But I would quickly mention that the 2 years prior to that, our returns were 2.1 and 0.6 respectively. So kind of like the same operating algorithms can return better than expected performance and less than desirable performance. So we're a long-term investor. This is something that CalPERS feels is its advantage over other investors in the market, is that because we're investing for pensions, because we're, by nature of the work that we're looking at generational work, and we're expecting the business of the system to exist in perpetuity, we can really invest for the long term, and we can really get leveraged in on investments in a much, much earlier window than firms that need to really produce on a yearly or even quarterly basis in order to keep their customers. So that's one thing I think that I would say to folks if there's some questions about CalPERS' ability to perform. But what we'll see in coming slides is that we actually see a pretty dim picture over the next few years.
So David, let me ask you a question on that. So as you know, asset allocation is the primary driver of long-term results. And what has been the history of CalPERS in terms of adjusting that allocation, whether it's bonds, fixed income equities, hedge funds, private equity?
So certainly, from the beginning, CalPERS and every other pension was 100% fixed income. And that was really easy to do when bond rates were 8, 9, 10%. If your goal is to return 7.5 or 8% and virtually risk-free, bonds, including U.S. Treasury bills, if those are returning 11%, heck, I can do that. I mean, that's easy. You literally just park the money in the account and everyone's on the golf course by 3. But as those interest rates have gone down over the years and really decades, our asset allocation has really shifted. And so now we're at, I have a slide here, I want to say 27% fixed income, and that leaves 83% for a combination of public equities, so stocks, private equity, real estate, and just kind of like liquidity, where we're moving the money around between market making or profit making, like day trading, essentially at 1%. So that's been the asset shift. We have definitely had to get more risk tolerant as the need to get the returns increases, and yet the availability of virtually risk-free investments dries up. CalPERS, like really every other pension fund and institutional investor, has really had to take on a much higher degree of risk. And that works well when we hit 11.2 and 8.6, but in 2008 we had negative 24%. That's the exposure that happens when we're compelled to pursue tougher returns in a market. I mean, we're subject to the exact same whims of the financial markets as every other, even the Joe retail investor. And I do have a slide that'll show the current asset mix, because you're absolutely right. That is the number one driver of performance, especially for a long-term investor like CalPers. Okay, you may have seen this before. This is a common piece of CalPers collateral. But it's a very powerful heuristic to understand where the money comes from. So what you're seeing here is a visual representation of every dollar that's paid out in actual pension benefits. That's what this is here. This is a proportionally reduced down the pensions being paid out. This is not specific to cities. This is not specific to your city. This is specific. This encompasses the whole 1.9 million members. If you took everyone's pension and boiled it down, here's where the money comes from. 61 cents of that comes from CalPers investment earnings, so more than half. 13 cents on the far right comes from member contributions. So anyone in this room who is a public employee member through CalPers is contributing automatically, mandatorily through their paychecks every single month. They do not have a say in the matter. Okay, so that's 13 cents of the dollar. The other 26 cents, and probably the portion of this buck that this body is most concerned with, is the employer contribution. Okay. This is paid by the cities, this is paid by the school districts, this is paid by the state, and it's roughly twice what a member is paying percentage-wise out of their paycheck. Some key things to note here is that by virtue of how pensions work, pensions provide a guaranteed monthly check, okay, or direct deposit, but there's a guaranteed amount. It's a known guaranteed benefit. What that means is that regardless of market performance, this full buck needs to be paid out. Okay? What I mean is that even if CalPers has a very bad year, let's say that we have another negative 24% year, God forbid, the full dollar needs to be paid out. We can't say, sorry members, sorry retirees, the performance just wasn't there, so we're only going to send out basically a 93-cent payment this year. It has to be the full dollar. So when the investment earnings aren't there, CalPers' only legal recourse is to go to the employers and say, we need you to make up the difference. CalPers does not have the ability to go to the members and say, we need you members to pay more. If that happens, it's really a negotiation through collective bargaining between the 26 cent and the 13 cent. And that's done at the individual level for every employer. And if you've been in this game for a while, you probably know that that's a tough conversation to have.
So we're responsible for unfunded liabilities in a down year.
That's correct.
Is there a stop loss on that?
There's not a stop loss on that. It could be considered a stop loss that we kind of phase in the costs. So if there's a particular down year and your costs are higher, those are kind of smoothed in. Smoothing is the term, over 5 years. And then there's now a 20-year amortization period for that. But nevertheless, if you boil it all down, there's no doubt that the employer is the one who bears the responsibility for any down years.
So is the 20-year period you're talking about PPA?
I'm sorry, that's not.
Pension Protection Act was speeding up the contributions?
No, this was a plenary CalPers decision just a couple of months ago. This was an internal policy decision to shorten. Historically, we had done 30 years, and the decision was made to lower it prospectively only, so not recalculating any past debts, but on a going forward basis to shorten it to 20.
Yeah, and so, we don't want to give the impression that in a down year, there's these dramatic swings. As you said, they're eased in over time.
Yes.
I think the actuaries call it a corridor, where
Yes.
Earnings in excess or less than this 7.5% you're talking about are amortized in over a period of time.
That's correct.
So David, what does this dollar bill or percentage-wise look like 10 years ago?
The 61 cents used to be over 70 cents. So you've seen definitely a steady decrease in the amount of investment proportionality here. And I'll I'll show you exactly why that's
And then maybe if you can just educate us, a number of municipalities have gone bankrupt. What has actually happened in terms of the benefits?
So there's been I could count on one hand, there's been a small number of municipalities and JPAs, Joint Powers Authority, and one fire district that have, for a variety of reasons, whether it's financial mismanagement, there's been some corruption. In one case, there was just simply more of a standard, listen, we've kind of run out of money. The benefits are cut for both active and current retirees. So what this means let me give you an example. The most kind of like chilling one would be the LA Works Joint Powers Authority, which was a JPA between West Covina and Azusa and Glendale and one other kind of city in this general region. And there were 122 folks, like about half of them were retirees and half of them were active members. They had 63% of the funds needed to fund their benefits, and they're the ones who had like corruption at the top, and ultimately their contract was terminated. And essentially their active members and the retirees receive 63 cents on the dollar of their pensions going forward. And that will be the consequence for all future agencies that, for whichever reason, can't make the pension
But
payment.
what about in respect to the employer responsibility in the event of let's say even a bankruptcy? What's their contributions? Is it still the same?
In a bankruptcy, the legalities are a little unclear on that. About 4 years ago, both City of Stockton and City of San Bernardino went through this, and ultimately they both elected to continue paying their full pension payments, even though they were in bankruptcy. The judges in the respective cases did just sort of issue dicta saying, listen, theoretically, we don't see why pension benefits would be sacrosanct versus other debts. But in both of those cases, the cities elected to continue making their payments. So we really haven't experienced what that will look like if and when that were to happen.
Thanks for that background information. It's very helpful.
Sure. Okay. This is an important slide, I think, to help shape understanding for kind of why the discount rate of CALPers has been lowered and what we see for the future and how that interacts with projected employer contributions. On the left, the left-hand slide here, we're seeing a view of the future from 2014, if that makes sense. So in 2014, the board came together, heard from our investment team, heard from our external consultants, and asked, what do we see? What are our best predictions for the financial markets? The capital market assumptions is just a fancy term for what do we project in terms of financial investment performance for the next 30 years. And as you can see on the left here, we predicted at that time an average of 7.1% for the next 10 years. And then see that the dark line, years 11 through 30, around 8.05. The reason for that more optimistic future is, like I mentioned earlier, CalPERS' value proposition is that because we can be patient and wait out markets and wait literally decades for returns to come in, for our bets to hit, we do believe that over time we can beat the market. So we thought, listen, 7.1 over the next 10 years, 8.5, that kind of, if you squish those together, that's about 7%, or excuse me, 7.5. That's why the discount rate has been 7.5 for a long time. Fast forward a couple of years, and when our investment guys took a look in the crystal ball, they saw a more dim future. Now, what we had thought was 7.1 on the right side here, the short term for us, that's 10 years, was looking more like 6.2, and the long term has lowered to 7.83. When you squish those together, it's no longer 7.5, it's closer to 7. And so that's why the very difficult decision to lower the discount rate was made, is because we couldn't honestly say that we expected to hit 7.5 over the next 10 years. It would be not just imprudent, but borderline immoral to assume that the system can hit it when we know in our heart of hearts that we don't expect to hit it. So that's why the discount rate was lowered. This was a tough one because, make no mistake, it has a direct consequential raising effect on employer contributions, not member contributions for the most part. Really, it only affects PEPRA members, folks whose contribution is tied to the normal cost. But that's for most cities, like the PEPRA has only been in effect for 5 years. This is a small fraction of your employees. It's not your highest paid employees by and large. So there's no doubt the employers bear the brunt of this decision. So that's why the decision to lower it was made, and we still think that. So you may be wondering, well, you just did 2 years of 11.2 and now 8.6. Our prediction still holds. We've been pleasantly surprised, really, that the returns have been so high these first 2 years. And it does give us pause, though. Like, our expectation is that there will be a market pullback here at some point. It can't be a bull market forever. It cannot. And so we've adjusted and calibrated the fund to be able to withstand as much as possible, while earning the returns that we need to withstand that anticipated downturn. Any questions on this?
Just the PEPRA contributions, that reform a few years ago was sort of our hope for the future. It was meant to be a way of moderating
Yes.
our future liabilities. So do you anticipate this curve of impacting PEPRA contributions in this way to curve out for that 10 years and continue to curve upward?
We don't anticipate major benefits for employers until around 2030, just based on the average working time of employees. So we're about 5 years into their work span. You start to see people retiring, at 17, 18, 19 years if they have prior service. And I've got a couple slides that show our best estimate of that. But I really, really want to caution this body and really any employer group that I speak to that we cannot put our hope in the PEPRA impacts. It's not going to be significant enough soon enough to withstand the coming increases in cost. So I'll show you that here in a second. It's just, you're not going to see the benefits. You're not going to see the cost curve bend down in time unless there are like really serious financial reserves here. It would be very challenging. Okay, this next slide shows the 3 major kind of like policy decisions that have been made over the last 18 months. If you had been up at CALPers every single month for our board meetings, they meet 11 times a year. These would have been the 3 major things that CALPers did that in respect to pensions and the impacts on employers. The first one I've mentioned a little bit here is the lowering of the discount rate. It's going from 7.5 to 7 in a 3-step phase-in drop. So that was a major one. Here is the asset allocation that we were asking about earlier. So 50% global equity, 28% fixed income, which is bonds, T-bills, a rather high 13% real estate or real assets, which includes real estate, especially commercial real estate, infrastructure, and then private equity, and 1% liquidity, which is cash on hand basically to actually pay the pension checks. And then we also have a team that literally just moves money around in interest-bearing accounts, trying to squeeze every last dollar out of this. Of these, like this, let's see, I should have made notes of this here, but out of this 8.6% that we just announced today that we're happy about, private equity returned 16%. So it was twice as high as the rest of the portfolio. Public equity was 11%, and within the private equity sphere are infrastructure investments, so bridges, et cetera, returned 20%. And so you're like, well, what didn't do well? The fixed income. Generally, if the stocks and more aggressive ones are doing well, then the bonds aren't, and that's what happened. So I especially want to focus on private equity, and towards the end here I'll talk about, and really honestly ask for your input, because CALPers is kind of at a crossroads here with private equity.
Do you want to talk about that now or later?
We can do it now if you're interested.
Just real quick, so what was the asset allocation prior to the July 1st, 2018?
Well, it had actually been slowly phased to be very close to this in late 2016. But what happened is we moved, an extra 4% into global equity out of fixed income. So we got more risky, and we moved 1%. We went from 7% to 8% in private equity. So we got more risky.
I would think you would show the breakout in global equity between domestic and international.
You know what? That's a good suggestion. I don't have the data here. We do have it. I can send that to you. We can break it down.
Thank you.
What about, what's the breakdown of the global equity and fixed income passive versus active management?
I'll have to send you that too.
It sort of sounded like in the real assets that you own individual properties. You mentioned bridges.
We do. So when we talk about the public equity and private equity, those are the ones that we really farm out a lot. So we do use external contractors, and we do put it into passive index funds as well. But when it comes to the real assets, we have more of an active approach, and we do have a team there that has that skill set. Private equity, not so much, and that's kind of the crux of where we need some input here, because we're looking to expand significantly our in-house talent on private equity.
Well, on the private equity side, obviously, the returns are higher, the risk is higher. I would infer that the fees tend to be higher on the private equity side.
A lot higher. And so let's just skip, if we could skip to slide 19 here real quick. We'll just tackle this one now. So what you're seeing here is 4 pillars, kind of if you chopped off the top of the Coliseum and looked down here. Pillars 1 and 2, emerging managers and partnership model. This is what CALPers has right now. So we look for, both of them are external models where we're looking for outside talent to manage and invest the money for us. So right now, our emerging manager program is where we're trying to find young, hungry, kind of like fund managers. They're emerging, and for us, it's less than $500 million under control, under assets. Assets under management, AUM. Then the second piece there is our partnership model. That's where we try to get as much money as we can with one of the top, and we invest with many, but with the top 25 or so, say, private equity firms on earth. Your KKR, the big boys, the ones that have the proven record. That's how we do it right now. It's completely external. Our private equity team internally, their job is to evaluate the performance of external private equity managers and allocate our money to them. What we want to do, because of the extraordinarily high fees in this space and the lack of transparency, which infuriates the state government. The state treasurer, who by virtue of his office sits on the CALPers board, I feel very comfortable saying that he is not a fan of CALPers investing in external private equity managers, because the money just kind of goes into a black box. It's invested, money comes back out, but it's very unclear how much of it is being kept in fees. CALPers has worked really hard to disclose this. We're sort of like industry leaders in the disclosing of fees and sort of how the hot dog gets made. And the unfortunate counter effect of that has been that now none of the private equity firms want our money.
So how do you go about selecting or steering your relationships when it comes to these private equity firms? Is there an advisory board? Is there simply the board of directors for CALPers gets in a room and says, we're going to use these guys?
They delegate that down to the investment team, so the staff, and then we work with external consultants. But really, that is the core job of the CALPers private equity investment team, is to have those relationships, to take those meetings, to evaluate those documents, and make the best investment. But really, what we've seen here over the last few years is that because even though CALPers can throw literally billions of dollars to a company to invest, that $1 billion comes with a laundry list of disclosure requirements. And you can't invest in XYZ sector, and you need to disclose, and we need to know everything, and you need to come to Sacramento and testify before the legislature about why you're doing what you're doing. And right now, it's definitely a buyer's, or rather a seller's market in the private equity world. Even though CALPers can offer billions of dollars, there are sovereign wealth funds from all over the world are looking to get into this space. And so we have not been able to, we have money sitting on a shelf that we're looking to put into the space that we cannot get invested through the investors that we want to give it to because we're just too much of a headache.
So I don't want to go too far into the weeds for the purposes of your presentation, but from a transparency standpoint, the selection process is done by a team. It's not an open bid process. It's not transparent in the way that the stakeholders get to see how all of that is done and or the fees associated with the selections that you make.
They do now. That's the work that we've done, is that we have worked really hard to, at least ex post facto, disclose the fees for the companies with which we are engaging. I don't believe that I know that when we're looking to start that relationship and to make that initial contact, we're not vetting that out through stakeholders. So I think you're giving voice to some of the concerns that we've heard. And so what we're proposing, and this was just brought forward to the board last month, so this is very fresh, is that we want to add pillars 3 and 4 here, which is essentially to set up our own internal CalPers private investment shop. This would be called CalPers Direct. That's the name of the overall program, and it's split into 2 different sectors here. As you can see from the top of the slide, the kind of hitch in the giddy up is that we do not feel that based on the way that the scrutiny that the CalPers board is under and the way that our public board is set up, we do not feel that we would be able to be competitive in this space. We would not be able to bring in the talent that we need to do this. And so what we're looking to do is to set up a whole different entity managed by 2 separate boards that goes in 2 separate directions. The first one would be the CalPers Direct on Innovation. This would be your standard private equity company that's making kind of like late stage investments in hyper profitable, high potential companies that haven't gone public yet. An example would be Uber or Lyft, something like that. Although they're too late stage at this point. We need to get in earlier than that. The other one would be Horizon, and this would be more of the kind of like Berkshire Hathaway approach to investing, where we're literally buying young companies or taking a majority stake in young companies at least, and then holding them for the very long term, for decades, in order to guide them forward and to reap the long-term profit from that. This is very different from anything CalPers has ever done. To our knowledge, this has not been done by any U.S. pension fund, but it has been done successfully in Canada, Australia, and New Zealand, and this has been a big profit center for them. So the crux of this is we need to pay for the talent that we need to do these investments for us. I see your hand, so let me just wrap this one real quick. The top paid investment manager at CalPers, the chief investment officer, makes $500,000 a year. That's great. I would kill for that salary. But the people that are making money in this space in private equity are making 15 times that or more. So there's no way that we can pay the salary needed to get a top player in this space to come and do these investments. And our point of view is that we want to get one of the 20 best human beings on earth to run each of these 2 sectors. We will not take
Steve Johnson.
we don't want to pay even just $1 million a year. We have to pay competitive rates, and the state structure simply doesn't allow. It would be illegal for CalPers as it exists right now to pay that much. We don't have that ability, and so that's part of the reason why we want to set up the structure. We want to get one of these like top dogs, and then really plunge more into this sector, because this is the only sector that for the last 20 years has returned double-digit returns. Private equity for the last 20 years has been a 10% or more returner, and it's the only one that we expect to exceed the discount rate over the next 10 years.
So I know you know this, but on innovation, so you had mentioned Uber or Lyft, but it says tech, life sciences, healthcare. Is it really what you'd be looking for is biotech, life sciences, medical innovation?
Yes.
So I work for a technology company that we won't mention, but we benchmark with some institutions, so the top universities you could think of. It is almost impossible, and I've seen their innovation portfolios to pick winners in that market. I mean, it is one out of a zillion. And I know companies that go to the universities and go to the national research labs and are dying to get their patents and their technologies, and it's 1 out of 1,000. So the level of risk there is, now, you're saying going in at a late stage, which is, certainly not incubation or something. And I don't want to dive into this too much, but that innovation area is extraordinarily risky.
I believe you, and yeah, that is the idea, is that that somebody else is taking the initial huge risk at least, and then we would try to capitalize on that. Excuse me. The board is having the board of administration is meeting next week actually, and we're having the second panel on from like some industry experts just talking about what are some technology disruptors. We're very, like most large investors, were fascinated by the potential impacts of things like artificial intelligence, autonomous vehicles, anything that kind of disrupts and tips over the current apple cart. It could potentially, if it's going to happen, then CalPERS wants to kind of harness that as much as possible. So I think they're just trying to get the lay of the land there. And then, like I said, there's literally no one at CalPERS who has the talent to do this right now. Zero. That's why we would need to go out and really start from the bottom up and create our own new vehicle there.
You're talking about, or CalPERS is talking about creating 2 new subsidiary boards, each with their own board members, to manage each of these 2 new buckets.
Correct.
Which creates 2 new levels of directors that are be paid salaries or fees, who will then be internal to go and reach out and seek out investment opportunities in these 2 new buckets.
That's correct. The only thing I would add is that there would be an arm's length distance between them and the current and the main CalPERS board. So CalPERS board would appoint the directors, and now there's a lot of blank space here. Like, this has not been decided, but they would be as autonomous as California has an appetite for. We think that that's key, is that in order to make these to have the flexibility to be able to operate nimbly, they need to be as long of an arm's length as we can manage.
In that case, where does their fiduciary liability lay? Does their fiduciary responsibility extend back to the member agencies, deep back to CalPERS? Or are they at such an arm's length that their fiduciary responsibilities are siloed within those boards? Or are their fiduciary responsibilities connected to some other entity?
Those are great questions. Those have not been answered yet. We would really need to get that dialed in. I would imagine that, so CalPERS fiduciary obligation is to make investments that can be reasonably assumed to be the best or have the best likelihood to fund member benefits. So the CalPERS current board, it's clearly for member benefits. The fiscal health of employers is a clear secondary priority. So I would imagine that this would be shaped the same way to some degree, but that's blank space that has not been filled in yet.
Like you're creating an autonomous entity that's sort of a syllogism, part of but not part of
Right.
the entity where we as member agencies who are making contributions have no idea really what's going on in those 2 boards and with those investments, and maybe not able to find out.
Yes.
Because they are not part of CalPERS. They're a quasi-CalPERS separate entity without a fiduciary responsibility to the members or the pension beneficiaries or the member agencies.
And making investments in not yet measurable marketed companies.
Yes.
So I think this is really surprising to us. It's really interesting.
I just think the fees overall, hiring all these, directors and paying all that, layering all that management in.
Actually, that's one where we feel very sure, just on preliminary kind of like back of envelope numbers, we feel very sure that that's going to be much less than the cost of our current, the first 2 pillars there. The external costs to private equity managers are very high. I believe it was a total of $3 billion last
The
year.
risk, but just the risk over, I mean, these, at least with these external, private equity guys, they're managing their risk. I mean, that's their job, to manage the risk. You guys are taking all that on without all of this knowledge, this background and everything.
Well, I
don't know,
think
it just seems
that's our
very-
goal. Our goal is to hire one of the top 20 people on earth at doing this, him and her and the team. And like, just now you're no longer working for KKR. Now you work for CalPers.
So why I mentioned that was surprising is that, and I'm not an investment expert or advisor, my understanding is that a lot of pensions much smaller than this are feeling that even the cost of active management are not worth it, and becoming passive. So if you look at it in 3 tiers, there's more of a passive management, active management, and this is off the charts. We're going to set up our own hedge funds, or
Hedge fund,
it is so far off the charts that I'm very very concerned about the amount of risk, and I know Warren's more knowledgeable about this than me.
Would these two organizations sell their services or compete somehow in the marketplace with the other private equity managers that you're talking about?
Yes, they would essentially, they'd be general partnerships, and they would be competing with the big boys on the world stage.
Would they take on other?
Great question, but no, they would be completely dedicated to CalPers. CalPers would be the only limited partner, I guess, in this sense.
So their risk would be if they don't perform at some benchmark compared to the other generally available equity managers, you would just eliminate them?
I think that's rough. I think they would be held to the same standard as the competitive private sector market. And there are, I mean, you guys, these are very sagacious questions, because these are a lot of the questions that are being asked, and there's no, I don't have a clear answer on the fiduciary. I don't have a clear answer on, what would happen if they underperform. It hasn't even been decided who literally signs their checks. I mean, would they literally be state of California employees, or are they being paid through some kind of different mechanism to free them up? There are a lot of questions here, and you've asked, and you've brought up the questions of who's really in control here. Is the potential of more profit? And I think most people looking at this say this has the potential to be more profitable than the current model. This can and probably will make more money, but is it worth the level of disconnection from the current oversight and governance? That is literally the question that's being answered or being asked. And over the next few months, this is going to be coming to the board again, and we're looking for sometime in early 2019 to have a decision, because this is not a done deal. This could very easily just say, you know what, this sounds pretty good, but this is a little bit too risky for us, and we'll just stay how we are. So we're looking for stakeholder input on this.
So David, so let's step back a little bit, right? So every consultant, Wilshire Associates, Cliffwater, you name it, they've got their asset allocation model, periodic table saying expected returns for private equity, right? Past performance is no indication of future performance, even though the past performance has been good for private equity. And every single plan out there wants more private equity. I mean, and like you just said, they're having issues trying to get invested, especially with your size. And so how is it that you think that private equity is the way to go? I mean, we've seen the issue with hedge funds. Previously, everyone was chasing hedge funds, and then now what do we see, right? There's been a pullback.
Right. Concern
Concern is, chasing something that's a high performer that may potentially go down with the volatility.
It's a completely valid concern, because you're right. Past performance is no guarantee of future performance. Just all I can say is that the investment team, in conjunction with Wilshire, is our primary consultant. They just predict that this is the best performing asset class over the next 10 years. That's their prognostication, and that this model has been proven to be effective for pension plans in other parts of the world.
But putting it all in perspective, private equity is now 8% asset allocation. What would these two tiers or peers be relative to asset allocation?
The number that was thrown out is that if this all came to fruition and we were able to get as much money as we were comfortable getting into the market, we want to push that up to a 13% ratio. And I don't know what that would come from, probably public equity, probably global equities. But they do want to push it up substantially with this.
All right.
I'm going
Very
to use a word that I don't mean it in its very literal sense, in that a structure like this is very susceptible to a corrupted process. And I don't want to use the word corruption, because that's not the case. The corrupted process being that as the city stakeholders, we need to be risk averse. And we have little to no control over what's going to happen here, other than what we discussed a little while ago, that if it goes south, then we could be impacted significantly. It could be feathered out over a number of years, but significantly impacted. And yet, as we discussed, the level of transparency and the levels of bureaucracy and opportunities for possible abuse seem to be a lot higher risk than what CALPers has been doing in the past. And I'm wondering if this is being done as a response to some other external stimulus, saying that we really need to alter our business model or we're going to have a lot of trouble down the road, or this is being done as, hey, we're seeing this somewhere else and we want to try and experiment with it. We see success elsewhere, or we're the vanguard here. And this is something that we're going to try out and no one has done before.
I think you nailed it, and you could probably give this presentation. It's really all three. I think that I can, speaking for CalPERS staff, up to the CEO, when we look at the future, we just see that the investment returns, kind of going back to that slide where I show the vision that we had in 14 versus now, we just don't see the good times continuing. And so we really feel an obligation to get the money into pockets of profitability now. And we really feel that obligation, for the members and for the employers, because when we start, and I'll just say when, not if, when we start to have suboptimal years where we start getting into even negative returns for a year or two, the impacts to employer contributions are just absolutely devastating. And to us, the worst case scenario would be, X percentage of cities that are kind of on that financial cliff, being faced with a situation in which it's listen, either we, default our CalPERS payments, or how many libraries and police officers and needed core services are we simply abandoning? If it's one or the other, that's a worst case scenario for us. So I think that's, our CEO feels really emboldened to be, kind of like that vanguard and be out there kind of on the cusp, but with the comfort of knowing that we know it can work. It works in Canada right now. And so we have that confidence. So I think that's why, CalPERS staff is very much in favor of this. We're pushing it. It's the board and stakeholders who have a little bit more reservations, and rightly so, but it's the unequivocal position of staff that we want to take this chance because we think it's worth it.
What about looking to increase on you said the real estate assets and you got a 20% return on infrastructure. What about, moving more into that area rather than all equity?
We like real estate, but CalPERS really got bit very hard in the Great Recession, just like anybody who had, from the individual homeowner to the biggest institutional investors, took a real hit on real estate. And so we are not going to be increasing that based on on that experience. And just, I don't think that the memory of that is still seared into us badly. So I don't think we're going to be more assertive in that particular one. And my understanding is that, like anything else, the the money is all chasing those investment opportunities. It's hard to get our money parked in those investments as well. So because there's a lot of competition from all over. It's truly a global market. So we're competing against, the largest investment conglomerates of all shapes and sizes for that too.
If you elect to go this route, I would really encourage, speaking for myself, a lot more transparency, a lot of sunlight on what those subsidiary boards are going to be doing, what the fees are going to be, how they're selecting their opportunities as much as possible. I just think that you owe that to their members. It scares me, but I understand you're trying to look forward. I get it. You're trying to offset what you see as a cliff. I just don't know if this is your rope down the cliff. This might just be your rocket behind you off the cliff.
Well put, well put.
I tend to agree with what you say, but even with transparency, what can we as a city do about it? If they make decisions that put us in financial peril, there's nothing we can do if we know every dollar that's in every spreadsheet.
And at the risk of invoking your wrath, I would present to you that there's not a whole lot that you as a board can do right now regarding CALPers investments. You can speak in public comment, but really the investment committee has the ability right now. So this would just be a different version of that a little bit.
That was the point I was trying to make when we opened the meeting, is that,
Sorry, I got into the weeds, and
That's okay.
all right.
Okay.
Thank you, David.
You're welcome. Okay, why don't we resume where we left off here, which was
Another rosy topic, the shorter amortization period.
Okay, yes, so we had moved, remember, these are the three major policy decisions that have happened over the last 18 months or so. So on to the right, the shortening of the amortization period. This was decided in February of this year, so this is quite recent. As I mentioned, for quite a long time, the length of pension payments, the schedule of payments had been 30 years, much like a mortgage payment. If you have a 30-year mortgage, your monthly payment is less, but you end up paying not just a little bit, but twice as much in interest over time. So it's kind of the question of, do you want to have lower payments or pay less in toto? And so the decision, based from our actuaries, and there was a lot of stakeholder engagement on this with especially the employer associations like the League of Cities, the Association of Counties, and the labor unions and everybody else on this one, because this does have, in likelihood, this will raise employer contribution rates in the future. So the decision was made to lower them. So for future pension obligations would be amortized out 20 years instead of 30. This is actually not a bad thing when you exceed the discount rate like we just did. You actually see those gains realized faster, but it would be pretty disingenuous for me to say that you can expect that. I don't expect you to exceed discount rate over the next 10 years, and so this will likely slightly increase your rates, but it will pay it down a lot faster. Very troublingly, the 30-year amortization actually caused negative amortization for the first 7 years. So if you remember back to the Great Recession with these kind of like adjustable rate mortgages, these were mortgages, if they're negatively amortized, your monthly payment was, not only was it not hitting the principal, it wasn't sufficient to cover the interest. And pension debt is much the same. So with a 30-year amortization, the first 7 years weren't reducing the principal or satisfying the interest, and so 20 years eliminates that. You start hitting the interest right away and start reducing the principal within a few years. So it's better long term. It's the prudent thing to do, but it's just another, I think, an employer, if I were an employer, I would look at this page and say, well, these were probably the prudent thing to do, but it's hurting the employer costs, there's no doubt. This is an interesting chart that shows the funded status of the system going back to 1993. So the funded status is simply the percentage of money that we have on hand and project to have versus what we expect to have to pay out in pensions. So looking to the far left, back in 93, we were 96% funded. We had 96 cents for every dollar we expected to pay out. And then you can track that blue line. as we get to 1999, the funded status went into what's called superfunded status, 128%. And so I don't know if any of you were involved in this back in the turn of the century, but this is when the infamous SB 400 legislation was passed, followed by AB 616 at the bottom. This is where a lot of folks, CALPers included, but labor for sure, and then ultimately the state and then cities and counties said, we're 128% funded. That money is supposed to be for pensions. We have more than we need. Why don't we redo pensions to pay out more? Why not? It's there. We have the money, and the good times will keep on rolling for sure. Well, unfortunately, that did not occur. So this is when the 3% at 50 formula for safety was implemented, and it was implemented retroactively. CalPERS signed off on this. The labor unions were obviously happy about this. Virtually every city did this, and the state of California did it. So every single person took action, and then you can see an almost immediate decline down in the blue line as we have the dot-com crash. We started to see then increases in life expectancy in 2014. You can see in 2009, the bottom of the Great Recession, we were only 61% funded. I mean, even in 2007, we had started to recover up to 101%. And then within 2 years, almost half of the fund fell out the bottom. That right there is the reason why CalPERS can't take on too much risk, is because when there is a recession, when there's a market downturn, it's absolutely punishing, and it's very hard based on how pensions are set up to recover. It's a slow-moving barge. It does not turn very fast. We don't quickly sell stocks and wait for them and short them. Like, we just have to hold on, and it's painful because even though CalPERS is a long-term investor, and we think in terms of 30 years, 50 years, the employers, we know that you guys have to think on a year-to-year basis. And the year-to-year performance of our fund impacts the next year's employer contributions that you guys have to make. So we don't always have well, we do, but, cities don't have the luxury of just waiting this out for decades. So the other thing that you'll notice on this slide is the bar graphs. The light blue bars are the liabilities, so how much is owed, and the dark blue bars are how much we have on hand. And the one kind of truism here is you can see that the light blue bars are on a continuing upward streak. As when the pensions were retroactively enhanced in 1999 and then in 2000, that coupled with market downturn, coupled with people expected to live 2 and 3 years longer, these are real costs. These are real things that have to be accounted for. People living 2 years longer is great, but it's literally 24 more pension checks that have to be paid. And that money has to come, as we saw in the pension bucket, only comes from those 3 sources. Okay. Here's our current funded status. It's gone up from 68.3 over the last couple of years, and we're currently at about 71%. This will need to be recalculated based on our current returns, but it won't be much higher. So the message here is that we're trending upward a little bit, but 71% funded is not good. We would be much more comfortable around 85 or 90. I've actually heard our CEO say that to be over 100% funded would be bad because it would likely result in, another 128, super funded, and then we would go right back to where we were people saying, let's just spend the money on pensions, and then we'll just repeat history. So we don't want that. But we definitely want to raise the overall funded status. For pensions, anything in the 50% range is very close to downward spiral. This would be where Kentucky and Illinois are. They have virtually no hope of ever getting fully funded. I really fear that their pensioners are going to see pension reductions.
For a corporation, anything around 80% is really bad.
This one we probably don't have to spend too much time on. So, what are some causes? It's basically the lion's share of causes for projected contribution increases come from the lowering of the discount rate. So that's because we don't see markets performing at the high level, we have to lower it. And then low returns 3 and 4 years ago, those have really disproportionately negative impacts. What I mean by that is like that 2.4 and 0.06, that's much worse than an 11.2% is good. Those are really devastating for employer contributions. So we really are doing everything we can to avoid that. That's why we can't take huge risks. That's why you may see some funds may have returned 25% over the last couple of years. They're way extended out there. CALPers just can't do that because the consequences of a downturn and a negative performance is really bad for us. Okay. Here is fresh numbers that I don't believe that you have seen before, unless Lori and Marnie shared this with you already.
They have. Thanks, Marnie.
Oh, man. Stole my thunder. So what we're seeing here is a little preview of the actuarial valuation reports that are going to be generated and sent out to everybody early next month. So these are as close to final as I can, but please don't, I wouldn't run with this all the way to the bank, but it's very, very close. So what you're seeing here is your projected contributions going out through 24-25 with that 11.2% from last year factored in. Okay. You will not see the benefit of the 8.6 until next year. Okay, but you do know that your next year's will be a little bit better because it beat the 7.5 benchmark. So like I said here, even though we returned 11.2%, because the discount rate is coming down, you can see that, in 2019-20 for miscellaneous, you can see that you were originally projected to pay $4.18 million. Now it's going to be $4.09 million. That's certainly better than a kick in the head, but it's not probably going to make Marnie sleep all that much better at night because the discount rate is coming down. So it's sort of offsetting, but it is better than we had originally projected, and you can see that going across here. This one here shows the safety, so those are richer benefits, so the costs are higher, and you can see again it's saving roughly $200,000 a year or so based on 11.2.
Even with that, we can expect from our 18-19 fiscal to 24-25 fiscal, so our obligation to nearly double.
That's correct. Yes. So what you would need is a series of, next year would need to be 20%, and the year after that 10% and 20%, like really high returns, and we just don't think that's happening.
And this is based on, as you said, well, you said this reflects the phase-in of the discount.
It does, yes. Yep, that's all in here. I'd like to skip this slide forward one. I'll come right back to that. So here's a look at the projected kind of like total costs for first your miscellaneous employees, so non-safety. What you're actually seeing on this slide, this is really 2 slides overlaid. Don't worry about the interplay between the blue line and the blue bars. The blue line here is speaking to the percentage access on the right. So this is the percentage of payroll over time. So right now you're at about, for miscellaneous, you're at about, 23% of payroll, and then going forward to 24-25, you can expect that to grow to about 35% of payroll. The blue bars tell the exact same story, just in dollar figures. So if you look at this bar, this corresponds to about $4 million, and then going up to about $9 million.
I'm sorry, what's UAL?
Unfunded actuarial liability. So your annual contributions are split out between normal costs, which is the service accrued by your workforce that year. Yeah. And then the UAL is essentially the unpaid debt from previous years. Here's what's sneaky about the UAL, and I mean, sneaky might be the wrong word, but it's different from any other debt in that it can accumulate even though the city paid their full payment in the past. You could still accumulate UAL. And the way I think of this is if you were to buy, let's say that you bought a gold watch using your credit card, and you You bought that watch, it was $10,000, and you paid that off over time, and now you own it outright. You've paid off that credit card debt. But the value of the watch is now $15,000. You would then, in the UAL world, you would owe that additional $5,000. So the value of the asset has increased more than the payment that you paid, and somebody has to pay that $5,000. And you did everything right, and you still have unfunded accrued liability. This occurs when people live longer than expected, as is happening. I actually asked our actuaries to look at what's the average lifespan for Redondo Beach employees. Your employees live longer than the average American. Okay, your female employees live to an average of 85 years, and your male employees, regardless of if they're firefighters, cops, or office workers, live to an average of 82 years. If someone's retiring at 50, that's 32 or 35 years of pension payments.
Are the UAL factored into the funded status that we saw on a previous slide?
Yeah, yes. Okay, that's an interesting way to frame that, but yes.
Okay.
Yep. Here is the same information for your safety employees. Okay, so again, the blue line corresponds to the percentage of payroll. So right now it's around 55%, going up to nearly 90% of payroll by 24-25.
So it's almost 1 for 1.
Almost. Yep. And then you can see the blue bars reflect the dollar cost, so going up from about 8 million to over 16 million. And that's with the 11.2% I've said. I don't mean to laugh, but it's like,
So if Commissioner Eugene makes $350,000, we would contribute $340,000 into his pension fund.
That would be nice.
correct.
To put it into perspective.
I mean, it wouldn't be 1-to-1 like that, but yeah,
Well, 90%.
right.
And then if he lived too long, we would owe more.
Looks pretty healthy.
I think Mel will take care of that.
Some gallows humor here. Yeah, so now let's go back. Now let's go back to slide 11. I don't know why my team put this way. Back to your question, sir, about like the PEPRA effects earlier. Here you can see this is just for the UAL portion. Not the normal cost is not the problem. Okay, the UAL is the problem here. That unaccounted for debt. So here you can see our best prognostications based on including the 11.2 last year. This is our best current estimate of what your payments will look like in the future. And you can see, especially for the safety, it's just on a rise until about 2030 when you start to see more retirements and folks from prior generations start to shuffle off this mortal coil, and you will see it go way, way, way down. And by 2045, the problem is solved. That's one silver lining. This will probably be well after most of us are done with this game, but there will be no pension crisis by 2045.
If we survive.
Right, if we survive.
I do not understand that. Why is that?
Because at this point, all of the classic members with the richer benefits will have retired, and the payments in from the PEPRA employees who have it's a significantly less generous benefit for folks hired after 2012. It's much less generous. You will, at that point, the balances will shift, and if, again, this is still projections and we're going out pretty far here, but eventually just the normal cost should be the city's contribution every year. It should be, barring some huge black swan event. But it's so far in the future, it really is a distant light in the tunnel. The problem through 2030 is very real, and cities really need to take a look at this and decide how they want to handle it in conjunction with their unions.
So what confused me is this is just the UAL portion
Yes.
of.
Just the UAL. The normal cost, based on current statute, the normal cost will always be paid and calculated the same way. And eventually, all your employees will be paying half the normal cost as their member contribution.
Really is dramatic.
So,
Go ahead.
can we buy the older, more highly compensated employees out of their current contract or buy them into retirement early?
There
And how
is.
does that get calculated?
It is called a golden handshake. You essentially, it's challenging. My understanding is that it's not done very often because it is a pretty big upfront balloon payment. It essentially adds, and I'm not an expert on it because it's so rare, but it essentially you pay up front like 2 extra years worth of normal cost. So it's a big upfront payment, but it would then get folks to retire earlier, which then should kind of shrink your total UAL for those folks because they should then have lower pensions because they didn't work as long. So that is available. It does exist. It is called the golden handshake, but it's pretty cost prohibitive is my understanding.
So this is more directed towards Marnie. What would be helpful, or I think maybe illuminative here, is to know the mix between the two groups of employees. And what's the plan called?
PEPRA.
PEPRA. Those are hired after 2012, so probably a small percentage, but I know we've had a lot of hiring in public safety especially.
I haven't taken a look at that. I know for whatever reason, our police department is taking a look at it, and they are saying, because we added an extra tier, which is kind of in between the classic. PERS still considers them classic, but
Tier 2, yeah.
but their benefits are lower than our tier 1 and the PEPRA. So between the tier 2 and tier 3, they are saying they're at about 33%, I think.
So, and regardless, I mean, these actuarial projections take into account those populations that we have. So it's, as you say, waiting it out to 2045 is a long time, and our current problem is now. All right, thank you. David.
Okay, scooting forward here to slide 14. We're seeing 2 separate things here. First off, this is just for your miscellaneous employees first. It's almost like 2 separate pension plans, really. They're very disparate. So your miscellaneous employees, you're about 1% better funded than comparable employers of average size across the state, so that's good. You're about 71% funded, just like the whole system. So you're right on par with the overall system, 29% unfunded. On the right, what you're seeing here, I just threw this in. You didn't ask for it, but it's just something to chew on, is that if the city wanted to explore paying off current pension liabilities and basically just saying, we're going to exit the CALPers system, we're going to pay a balloon payment to satisfy current pension obligations, what would that look like? By that calculation, you're only 45% funded, and you'd have 55% liability. The reason why, and I expect some folks will push back on this, is that when an agency terminates, since CalPERS is no longer able to actively manage the fund and in down years go to the employers to increase contributions, the calculation rate, the discount rate that's used to calculate the liability is done at the U.S. Treasury rate, the essentially risk-free rate, which right now is right around 3%. This causes the cost to go up like right through the roof.
And to be clear, this doesn't get us out of our pensions. It pays off the earned obligation to date, and then we would need to provide pensions from today forward.
Well, you could technically switch to a 401k if you wanted at that point. What this does, and a piece that a lot of folks don't recognize is that, let's say that you hired a person yesterday, literally yesterday. If you were to terminate liability, you're accounting for his pension at that formula for his predicted working career and retirement life. So by California constitutional law, you'd be taking care of everybody who was hired under the auspices of having a pension. It would just be the guy who gets hired tomorrow who wouldn't have one.
So on that, I guess they're both the same. What is the roughly the dollar value in today's dollars of the total pie?
It is $502 million for safety and
Power plant's
miscellaneous.
worth how much?
Sweet. 200 million.
Yes.
So-
This would be why cities don't do this.
Because I'm not embarrassed to embarrass myself, I have a question. Let's say that, so certainly a city could go ahead and exit and set up as a benefit for their employees instead a 401k plan or some other retirement benefit plan.
Yes.
Defined benefit plan, as you would. Are there situations where a city does both and transitions, where employees after 2020, all new employees will be on a 401k plan, and all previous employees will still be on the existing Tier 1 or Tier 2 plan that we have in place right now? And that would maybe bend the curve a little bit faster for future obligations.
No, that is not a model that exists in the under current law. It would have to be the way I said it earlier, which is you would have to account for and prepay the predicted pensions for every single current employee, every single
You're in or
current
you're
employee.
out.
You're in or you're out. Then after that, you could hire them with a 401k, a 401b, a nothing. I mean, you would be out, but like you would have to account for all current employees.
So then by extension and logic, this is where, we're not going to come up with $500 million. So we are in for a penny, in for a pound. We're all in this for the long haul.
That is correct.
You'd also,
And we need to find out a solution to these future unfunded liabilities, a solution for this curve, if we can survive out, survive out to 2045, is basically what we're talking about here. Okay.
even if everybody you hired from today onward into a 401k, you would be shocked how long it would take for the contributions to come down quickly.
To curve downward, okay. And you may put yourself in a bad competitive, or in a competitive disadvantage when it came to hiring.
Yes.
Absolutely.
Right,
That-
okay.
I think they would make the argument we couldn't hire anybody.
Yes.
Oh, I'm sure that argument would be made. I'm just trying to go ahead and knock all these dominoes around the table and see what solutions are out there, if any, explore those things. May not be the best time for it, so thank you, David.
No, it's excellent points.
So you set me up very nicely here. So since the termination, balloon payment is not realistic, here are 3 strategies that other cities are employing right now to address and at least somewhat mitigate those rising costs over time. So basically survival mode. That's what this is. So the first one, and probably the most powerful one, is just to make ad hoc additional discretionary payments, ADPs it's called. And this is simply prepaying your pension costs now when they have more impact on your total UAL. Just like making extra payments on your mortgage, just like making extra payments on your credit card debt, the more you pay early, the more you save in the future. It's just that simple. So CALPers is very flexible in taking more money from cities. So we will take it on a monthly basis or an annual or every 17 days, whatever you want. Send it over.
We like to pay annually.
So that's one approach. The Fresh Start program is not as good as it sounds. Like, Fresh Start, yes, please, start over. It doesn't work that way. What this is looking at the different, this is getting a little bit into like actuarial semantics a bit, but every year that you get your valuations, your UAL and normal cost is based on a certain set of developments during that year called a base. And so really every year you sort of generate a new now 20-year debt and past 30-year debt. And so the total bill that you get is really the sum total of each of your past 30 years or 20 years of amortization bases. In some instances, you can look at those bases, and some of them, it may be advantageous for the city to pay down faster, and you can like zero in your payments on a specific base, kind of sort of like paying off your highest interest credit card first and paying just minimum on your lower ones. and long-term that will save you money. So this is one where I need to put you in contact with your assigned actuary. It would be your finance director, city manager, really looking line by line through the actuarial tables to figure out, hey, is there a strategy here that would save you at least some money if you were to, allocate your payments a little bit differently. So that's another way. And then lastly is to set up an IRS Section 115 trust. So I don't know if the city's doing this already, but essentially you're setting aside money into a different pool and then using those funds to pay down pension debts at a time that makes sense for the city. Okay, now this one, I just want to show you what this could look like. These numbers are not real to the city of Redondo Beach. This is a hypothetical city, but it'll give you the point here. The gray line, okay, the gray one that's kind of mountain looking, this is a rough approximation of your pension contributions going forward in the future. We're right now at kind of lowish, and then it really goes very high, and then it tapers off in the future. The problem here is really these, in this example, years 25 or so through 2030. Those are the high years. For a lot of cities, they simply don't see how they could ever make yearly payments of this high. So going back to this slide, like this approach right here, the ad hoc additional payments, the ADPs, that's what we're doing here. So with the orange line, this is saying, let's pay a lot more than right now. Let's pay more, but it will never get as high as the way it will be if we just pay the minimums. So it's paying a lot more. It will hurt, but a lot of cities would say, we can do this. We have to grit our teeth. It's going to hurt. There's going to be sacrifices, but it's doable, and it never spikes up to this part that is simply not feasible.
So while, Marty, while that's interesting, that's not, any prepayment is not feasible for us, right?
We're having trouble making.
We don't know
our-
how we're going to
our
make the
current
scheduled payments. Right.
But in going over this, presentation with David and our actuary and some other staff, we did speak to the actuary and say we would like to have some discussions on what can we do. Right.
And it's interesting because, like on page 10, we don't see anything past 2025. Is that, David, is that something that's known at this time, what we think those numbers are going to be?
These charts right here,
We're just so far out there by the time.
exactly, it gets so hazy that it's tough, but where is it? The one.
10.
And they
yeah,
do add
10.
each
Yeah.
year's valuation has one
One
more
more.
year.
So yeah, these are as far out as I guess the actuaries feel professionally comfortable saying this is as far as their vision goes for sure. Anything else like these charts right here, it really should be like a hazier blue line the further out you get. There's so much can happen in decades out in the future. It's tough.
Marnie, I'm sorry, Steve.
No.
In the budget 18-19 estimated, you estimated out to 24-25 for us to 24-25 estimated cost to be $26,691,000. Did that include or exclude the UAO?
Include.
Includes. So in 24-25, here you've got
And now, like his chart towards the beginning, now with this 11.2 built in, it would be a little bit lower
than the 24-25,
than what we
26
did in
million.
that budget response report, yeah.
And you know that the next year will be a little bit lower than that even, because now we know that the last fiscal year was 8.6, so it will be a little bit better, not much, but. Okay, so we covered these ones already. We're definitely rounding out to the end here, so this is my last real slide. So I mentioned earlier, the staff at CalPERS really takes this very seriously. We're really, really committed to driving up the investment returns because that's the one thing that we have at least a measure of control over. but not total control. That's what's frustrating, is that pension administration is really a difficult exercise because there's so many unknown variables. So what our CEO, her name is Marcy Frost, she is a stone cold killer. She has been there for about 2 years. She is very focused on getting this pension fund to be as profitable as possible, because that is the only thing that is going to take the financial pressure off of cities, or at least keep it somewhat in the realm of management ability. So we're really focused on making sure that our stakeholders are clear on what CALPers' role is. And I don't want to get into politics or anything right now, but if you follow the media at all, there is always calls, and there are always folks who see CALPers primarily as a representative of California as an investor. And CALPers should not be investing in things that California doesn't believe in, et cetera. And our firm response to that is CALPers is about funding benefits for members of the system, and that's it. We, at 71% funded, we really don't have the latitude to be agents of ideological change. Our goal is to get our funded status up to pay the needed, to pay the member benefits. And
So we're all in for tobacco if that's the way to go.
and yet, here's the thing, like I say that, and yet the board, this is the board's written policy. They have agreed, yes, we believe this. And then literally the next year they voted to stay divested from tobacco. So like it's still human beings on the board. I would say that, and the board would, I've said this to board members, I'm like, the board is a political body, and CalPERS staff is trying to make money.
For what it's worth, I applaud the CEO's approach to that, is that, given the numbers that we're faced,
Yeah.
and the future that we're faced, and the mass of the CalPERS, $350 billion, we're not an engine for social change, and others may disagree with me, but.
So along those lines, David, right, I mean, we've seen it historically, right? Ex-South Africa, tobacco, and what is the next slide here? ESG. I mean, it's just the same thing over and over, whether it's divestiture or only certain types of assets that we would invest in. And what's the cost? Lower returns.
Right. And who bears the cost? The employer, not the member, the employer.
I mean, ESG is the hottest thing right now, right? I mean, the two things, private equity, ESG. That's all anyone's talking about.
I'm sorry, what's ESG?
Environmental, social, and governance.
got it.
Right, so let's say we've invested in,
Green.
say, yes, exactly. Sustainability is a better word.
Go
Yeah,
FANG.
it is better. Yeah.
Anyway.
Yeah, so but make no mistake, CalPERS definitely exists in the political realm, because of the nature of the board. The state treasurer is the biggest advocate of social-based investing, and he's on the board. And there's nothing you can do about that. But I just want to assure you that CalPERS staff is really focused on, working within that framework, but really we're trying to work with our stakeholders to help them understand that our fiduciary obligation is to fund the member benefits, and we want to stay laser focused on that. So to the extent that the city, engages through the league or advocates, at the legislature, CalPERS has the ability to make any investment decision within the law. So if the legislature changes the law and narrows the playing field of what we can invest in, then we do have to obey that. So, whether it's thermal coal or guns was a really recent one.
Real estate.
These are issues that are real, they're meaningful, we get it. But in terms of investment performance, it just can't be our primary consideration. And that's staff's perspective. It's not every board member's. It's probably not everyone in this room's perspective. So it's a tough one.
So let's put you on the spot for a second,
All right.
if we haven't already. There seems to be, my perception is, a lot of drama happening with the board up there at CalPERS. And I don't want to get into the granular level, the minutia of it all, but how is that affecting operation? Is there friction between the board and the staff about direction, or are we all rowing in the same direction?
The staff, like I said, we're really unified under our CEO. And like, my boss is the CEO. I don't report to the board. Only the CEO reports to the board. So I do what she tells me. And I also am convinced and persuaded by her arguments. So I think staff is very clear on making the money, and then realizes that we're not a private sector entity, and that these considerations are real, and that's just kind of the sandbox that we have to play in. But it's more like there can be some exasperation sometimes, like, you're making it a little bit tough for us here, but there's no dissension like that. Or huge friction.
So one of the things that you hear about at our council from time to time is an emphasis that the council not allow staff to direct policy in an indirect or a direct way. There's some of the things that I've read about where it seems like the staff really sort of drives a lot of the decision-making, and maybe some of the board members aren't so active in investigating and deliberating some of the things that they maybe should be. And that staff drives a lot of the direction up there at CALPers. So I just bring it up to illuminate the idea that the CALPers board and the staff and the way that they work together. You said something that's both depressing and very illuminating earlier, is that we don't have a lot to do with any of that. So we're relying on those board members to rein staff in if that's what's necessary, or for staff to educate the board members if that's what's necessary.
Right.
And the more that you all get along, the better it is for all of us.
Yes.
So what I see and read about seems to be that that's not the case right now. Am I under a misapprehension?
I think it's a little bit, it's always going to be a more fun news story to identify some of the more inflammatory interactions. I would just point to, like, as far as staff driving it, I would just point back to that tobacco situation where staff was very 100% unified on, we should be able to invest in tobacco stocks and not have that taken off the table, and the board just flatly rejected that. So that would be one recent example where there's no way you can say that staff is kind of leading the board around. That being said, though, the board, this is a lay board. There is no prerequisite that they have to be investment professionals, or they also oversee healthcare for 1.4 million families. Like, there's no prerequisite. Do you have any experience in health? They are either elected or appointed or serve ex officio by virtue of their other office. So it is a lay board, so they really do rely on staff.
So educate me for a second. How does a person come to be on the board of directors at CALPers?
Well, they all have different paths. So there's 2 of them. There's 13 total. 2 of them are elected from the membership at large. So any of you that are CALPers, either you have a pension or you're paying into it, you can vote, whether you're active or retired. So there's 2 of those. There's one that's elected by members of public agencies, like cities, and that election is coming up next. State and schools have a similar one. Then there's one board member who's appointed by the legislature as a whole.
Are they appointed for a set term?
Yes. But some of them can just be pulled, like the one appointed by the legislature was Ron Lynn for 7 years, and then the legislature just decided to swap him out with someone else over a different issue.
That tells me a lot. Okay,
Yeah.
thank you.
But then there's the state controller, the state treasurer, and the Cal HR director. Like, whoever gets those posts is automatically on the board.
Okay.
So they're very different agendas there.
Yes. Okay. Thank you. So it's much like for a lot of our boards and commissions where we rely very heavily on the staff for the information.
Yes.
And it's
that's
always
fair.
amazing.
Yes.
Thank you. Thank you, David. That's a great presentation.
You're welcome. Yeah, so that's all I have as far as formal material to present. I'm happy to take any additional questions, and then here's my contact info if anybody needs to shoot me questions afterwards or wants to stay in contact.
Well, I've got a question talking about overall payroll growth and the impact on these future liability payments. Can you talk to that at all? Because I see in the documentation we received, it talks about the assumptions are based on the 3% compound growth annually. And then there's another discussion about inflation, a 2.75% inflation rate what does that do to our liability payments over time?
That's all factored into what you're seeing here on slide 11, which is just the UAL payments, but that's really the bugaboo here. It's not the normal cost. It's all factored in. So all of that, like the assumed inflation increases, life expectancy, all those are all just called actuarial assumptions as a whole. That's all factored in. The biggest impact is the discount rate and investment returns. Those are that's 1A and 1B, and then like things like life expectancy are like G. They're not close. It is investment performance with applied to those frankly very generous pensions that we have here in cities in California.
So if we've got, especially on our safety side, if we run 5% annual growth rates in payroll, that's not going to have a dramatic impact in that curve?
I think they assume 3% on this, right? Yeah. So if overall, salary increases or growth in like the number of people you have deviates from these expectations, then it would impact it. But they're pretty. I mean, they take a pretty good look at comparable employers in the past, based on they're looking at a lot of economic factors to make the best possible prognostication. But yes, if the baseline assumptions just change radically, yeah, that would drive up the costs. Yes.
Yeah, I think it's a great point that to the extent that the salary increases are one of the actuarial assumptions.
Yes.
And to the extent that salary increases exceed that, then the arcs will be sharper.
Is there any way that we can get any estimate of that, or what do you need, what do we need to do to get an idea of what those impacts might be? So particularly, and what I'm thinking about in particular, are the pre-PEPRA employees that are here.
Classic.
And the classics, and what does their salary growth look like? Because they're probably at a point now in their careers where they're likely to be promoting quickly, and they will obviously get salary increases out of that, along with inflation adjustments and so forth.
Those are actuarial, like that is the business of actuaries, is to take a look at the statistical likelihood of all of those things you just mentioned, like folks who have these higher salaries at the age 40, they would expect to increase X percentage by the time they're 50. That's their job. And so they're crunching all of those numbers. If you wanted to kind of play with some hypothetical scenarios, I would have to direct you and your finance director to talk to an actuary, and they could kind of adjust that. But what you're seeing here is sort of, it does even out like over time. For every salary increase that comes in there, like maybe you don't backfill a position, and like it sort of averages out over the long term. I mean, that's why they call it actuarial science, is that when you take a large enough pool of people, it becomes pretty darn accurate over a long enough period of time with enough people.
David, could you clarify, are there separate actuarial assumptions for the city of Redondo Beach as compared to all others? So
Yes.
we have, our city management has provided estimates of salary increases, and no, you haven't. Who does?
There are, like, for example, the numbers I gave about the life expectancy, that is specific to City of Redondo Beach, given the demographics. So you may kind of fall in sort of like a tranche of other similarly composed cities of similar size and things like that. But the actual science becomes less reliable the narrower the field. So I think they cast as wide a net as they can, or as narrow a net as they can. That's not much of an answer.
But point taken that abnormally large salary increases will have unintended consequences, but predictable, difficult to predict, but they will have increases on the pension costs as well.
Yes.
Further questions, commissioners, before we open up for public comment? Thank you, David. Thank you, Marnie. Is there any public comments? State your name for the record, and we will use the clock. Cami? 3 minutes?
Honey, District 3. First of all, this is not direct investment. Don't take my word for it. Dan Primack, who's one of the top private equity observers, commenters, pundits, and is, I believe, a CALPers consultant, has actually dissed this plan. This is indirect. And I quote from Yves Smith on Naked Capitalism website, CIO Ted Iliopoulos apparently wants to relegate CalPERS not only to being a mere limited partner, as in a passive investor in its 2 additional investment rackets, but to interpose 2 layers of boards between them and CalPERS. One can only include he wants to make damn sure CalPERS has no idea what is going on with the money it commits to these vehicles, and that they are even more of a black box than private equity is already. It appears that avoiding even the weak disclosure called for by California law is of paramount importance. I would point out that Mr. Iliopoulos is leaving at the end of this end of this year. There's also a gentleman named Charles Osby-Totten. He was CFO of CalPERS until he left real recently after it discovered he'd lied on his resume. She mentioned CEO Marcy Frost as being committed to making sure CalPERS is fully funded. Well, she seems committed to a few other things, too. Between her and the board president, Priya Mather, it seems that they have been signing, along with board members, pre-signing expense report forms that are blank in violation of the California Penal Code. One of the employee representatives recently elected is Margaret Brown. She's a reformer. So far, in the few months she's been in office, she has been locked out of the building. She has been denied access to closed session minutes from previous board meetings, especially on private equity. She's had her microphone shut off, and the president is opening and responding to mail sent to her. This does not inspire much confidence, much less reflect transparency or accountability. And by the way, your 7% figure is a joke. Over the last 10 years, CalPERS and the other major funds have failed to return on investment equal to one of the Vanguard funds. So we've got all these people up here and all this expertise and all this staff, and we're spending all this money not to accomplish what we could with a Vanguard fund. This is a joke, okay? And we're going to pay the price.
Thank you for your comments. Appreciate that. Commissioners?
I think we have more public comment.
Can I have your name and district you represent?
Hi, Ilya Klinger, District 4, also Historical Commissioner. Want to thank David for the very detailed presentation. And I do hope that with the 2 new funds, we'll be seeing the same level of transparency. I echo the Commissioner's concern over levels of transparency. I was just wondering, would we be able to do something like, if we're to do a balloon payment, would we be able to maybe float a city bond at a certain percentage figure that's less than what we have to pay, and then use that as to prepay the costs of UAW or UAL?
It's just public comment. You just have to address the board, please.
Okay. All right, and is there, okay, then there's anything the board can do, like maybe propose a proposition so that we won't have to deal with the politicization of it, because politicization kind of sounds nice and all, but if the board is not paying the cost to make themselves feel better with their own political decisions, it's the cities that are paying the costs. So like maybe there's a proposition that we can do to stop the board from doing that. Because if tobacco is profitable, then that could be something that we could we should be able to invest in so that the city pays less. And then lastly, as a historical commissioner, I just wanted to mention that we are working with a couple of other commissions on bringing the Olympics to Redondo Beach. And I was wondering if I think there's a letter or something that could potentially be agendized later on, maybe in referral to staff or something like that at the end. Thank you.
Thank you for your comments. As a reminder, the Budget and Finance Commission does not make policy.
So the question that Ilya was asking, I think, is do cities who look for a buyout or look to offset the costs of some of these unfunded liabilities use other funding mechanisms? Is that something that's permitted?
From CalPERS perspective, it doesn't matter to us.
Just wherever the
It's-
money comes from.
Right.
Okay, thank you.
I mean, the city can technically
If
float
you're gonna have
any
a
bond measure,
if you're gonna have a
right?
bond measure, it's gonna be for something like.
Like a new police department.
Yeah, I understand. Not to pay off the
Building,
employees.
Further comments, commissioners?
Other than thanking David again.
Thank you, David, for your time. We really appreciate it. And
Thank you.
Marnie, for your time, too.
My pleasure.
Thank you. Thanks, Barney.
Can I have a motion to receive and file?
Motion to receive and file.
Can I have a second? All in favor?
Aye.
Aye. Motion passes. Item number 9, member items and referrals to staff for budget and finance.
I would like to take up the issue that Ilya mentioned, which is that we are bringing the Olympics to Los Angeles in 2028. And what he's been doing is organizing the group of commissions. And the idea, if we could agendize a discussion or we could create a letter coming from Budget and Finance to either City Council or the LA Organizing Committee in support of having ceremonies and events in Redondo Beach. And I think that if we are permitted as a commission to have a letter drafted in support of bringing ceremonies and events to Redondo Beach, something that I would like to try and do.
I think that's a city council policy, not a budget.
I mean,
That's
Well,
not.
we're not trying to create policy, we're simply issuing a letter to the city council or in support of,
saying that we support it as a commission
yes,
to the city, to our city council.
to our city
Okay.
council.
To the extent that it creates economic activity in the city and furthers the reputation of the city without creating risks that our chief of police will have to deal with. I think, balancing all those things, then it could be favorable. That's
Yeah, I
something
think
that
it'd
we
be
might
favorable
recommend.
economically, for sure.
Local businesses.
We don't have enough, employment in this city. I mean, just
So,
bringing more people in here.
I would ask, make a motion to agendize a discussion to create a letter to be presented to the city council in support of bringing ceremonies and events to the city to foster economic advantages for the city.
I would second that.
Yep.
So before I put on a vote on that, so so it would be on our next agenda rather than have a motion. Okay. Yeah.
Well, the motion is to place it on the
Yeah,
agenda to
that'd be
discuss.
fine. I think that would be fine.
Yes.
Yes.
Okay.
Any discussion is fine.
And I seconded that.
All in favor?
Aye.
Motion passes.
Thank you.
What about some of the leftover things from the budget? I guess we had a discussion about getting some further insight on the outside attorney fees we're paying, and also we had a minor discussion about, or a recommendation that we look at the highly compensated salaries. So I just wanted to know how we were going to move forward, what our game plan is on those items.
Were those things coming back to us, Marnie? Was that something that is in the pipeline?
City attorney will be asking, like was pointed out, him being an elected official, city manager can't direct
Oh, I see.
him to attend your meeting, but we will ask if he would be interested. And the highly compensated employees, was that?
We, I guess we had, a discussion about how there was, so I don't have all the notes, but there was several, well, actually I do. There was several positions that were, well, like 26, I said that were, that I counted up from, and this was all from the what is it called, the California
Transparency,
California. Right. That there was 26 positions making over 300,000 in total compensation. And we had just in looking at, are we in line with, cities of our size, or are these highly compensated positions, are we, over what other cities are paying for the, same type of positions?
Now, is that just built into your letter to council, asking them to look? That's
Yeah,
kind of
it
how
was-
I'm
it was one of
remembering
our
it, and then,
recommendations, right?
and then it was up to council to take any
Right.
action.
Right. It was, but I was just wondering if, I don't know if they're going to do any action on that. Was there any discussion?
There was
any
no
talk?
discussion of
Yeah.
it, no.
So, but there's no reason why we can't, discuss it and see if there's, we can find a way that we can do something like that.
Well, I think-
for
I think-
review if the other commissioners agree.
I think we already submitted it. I think we can look at it, and let's give them some time. I mean, they also did the bargaining, correct? Is that still ongoing with the,
It's still going.
still ongoing? So I think
It will
once,
be
I
for
think
many
once,
months to come.
I think we should just give it some time.
Okay.
And given that the collective bargaining is going on right now, we can revisit it in 6 months from now.
Okay, at the mid-year, you mean?
At a future date, I think there's a lot on their plate. I think we submitted it.
Okay,
If we still have concerns, we can talk to staff directly.
all right.
I concur with that.
Further discussion, commissioners?
So, so as far as the, you're just going to ask if he would come and speak with us? Okay.
Is it possible, since the city attorney's an elected official, but the city attorney's staff are not elected officials, and there is an office manager, that one of those employees could come and speak with us about the procedures and internal policies of that department?
You know what, I'll have to find out for
I'm
you.
kind of going to lean back to Warren's comment, is let's let the city attorney answer.
Give
when
them
he'll
some, yeah,
come.
let's give them some time. I mean,
And he may
it's,
say yes.
I would be surprised that they would say no, I have no requirement. Or maybe you wouldn't be surprised, but let's see what happens.
yeah, let's give them some time. I mean, we already had the fire, we already had police, and city staff is doing well in terms of giving us transparency and bringing library.
Okay.
So that's 3 out of
Always give
3.
somebody a chance.
3 out of 3 is pretty good.
It is.
So, one other thing, Marnie, so we still haven't the minutes from the previous meetings, right? So we'll get, I guess we're 1 month behind.
So tonight you approved the first budget meeting.
Right.
Your 3.5-hour meeting, so
Right.
that's a lot of minutes.
Yeah,
Your 4-hour meeting
Okay.
is still being worked on.
yeah, no problem, I just want to
So
make sure.
it'll be ready in time
Yeah,
for the
so this
next
is only a
meeting.
2-hour meeting tonight.
So this one should be done quicker, yes.
All right?
Make a motion to adjourn?
We have to close this
I beg your
item.
pardon, sorry.
We have a motion to well, we only have one motion regarding a letter for the agenda, right? So we already passed that. So do I have a motion to close item number 9? Second. All in favor? Aye. Item number 10, adjourn Budget and Finance Commission. Do I have a motion?
Motion.
Second? All in favor? Aye. Thank you, everyone. Thank you, Marnie.
I went and bought some beer because the last couple of times we were here for those 4.